Today, the Greek parliament is going to vote on a €30 billion austerity program of spending cuts aimed at reducing its deficit. As we do every day, we partnered with the FT right Lex on Bloomberg so you can get a sneak peek at the Financial Times flagship column a day early. Neil Buckley joins me now live from London. So, Neil, the Greek parliament is voting on what you'd have to call severe austerity measures. We saw yesterday how many Greek citizens are responding with riots, Molotov cocktails. They had to fire tear gas. If the cuts are passed, what's it going to mean for Greece?
Well, as you say, the demonstrations that we've seen in the last couple of days have really provided a graphic and rather tragic demonstration of just how difficult it is going to be for Greece to make these very brutal spending cuts. And we're taking a look in Lex today at how difficult this is going to be for Greece. Now, of course, it's trying to cut its budget deficit by 11 percentage points of economic output over the next few years. That is a huge cut. There are some examples of countries that have managed this before, but usually those countries have been able to do a couple of things. They've been able to devalue their currencies and to loosen fiscal and monetary policy. Greece can't do those things because it's a member of the Eurozone, so they're out of its control. If you can't devalue your currency to make yourself more competitive, you have to undergo what economists call an internal devaluation. That means you have to lower wages, lower prices inside the country to try and make your economy more competitive. That is really a very tough thing to do in the midst of a recession.
Neil, this brings to mind Latvia, because Latvia tried to do something similar to Greece. Are there any lessons from Latvia's experience that the folks in Greece might want to take?
Well, Latvia is the nearest example to this, because Latvia, although it's not a member of the Eurozone yet, its currency is pegged to the euro because it wants to become a member of the single currency. In late 2008, it agreed a €7.5 billion assistance program with the IMF. As a result of that, it made some really swinging cuts to public spending and to the size of its public sector last year. But those cuts increased the size of its downturn. And actually, its economy shrank by more than a fifth last year, which is one of the biggest contractions seen anywhere since the Great Depression. Now, the effect of that, having a smaller economy and having tax revenues falling, means that its budget deficit only got bigger. So that's an example of just exactly the kind of difficulties that Greece could face.
Well, Neil, I know you have been taking a close look at this over at the FT, and so have all your colleagues. What are the economists saying? Is Greece likely to undergo a similar experience to what happened to Latvia, as you just outlined?
Well, if Greece sticks to, if it passes today and then sticks to the kind of austerity measures that it's contemplating, then a lot of economists certainly fear that it could see deeper than expected or deeper than projected shrinkage in its economy this year, which will make its deficit and debt problems even more difficult. But Greece, Greeks themselves may be a lot less willing than the Latvians were to put up with these kind of hardships. The Latvians, of course, after the Soviet collapse in the 1990s, went through a very tough time. They have recent memories of going through these kind of difficulties. The Greeks have more experience of being relatively wealthy. They also have very powerful unions. So the markets, I think, are going to continue to be very skeptical about whether the Greeks can manage to pull this off.
Skepticism is the order of the day. That's Neil Buckley from the Lex desk in London.